Portfolio Builder members, we're now up 51% year to date, while the S&P 500 is up 17%. That's a 200% outperformance. Let's jump into our high risk portfolio allocation. Last week, we made a trade alert. Most of those went up in value, and there's no changes today. If you know, we increased the UVXY position. That's down a little bit week over week for us. The big bet was to go more aggressive on treasuries, where we added a 25% position, and that's been going straight up for us with TMF. That's basically betting that interest rates are going to fall on the long end of the treasury curve, specifically the 20-year. And that's really a bet on the amount of issuance slowing down, tax receipts going up, and inflation falling over the next year, perhaps 2 to 3 years. So it's a big long-term bet that we're highly confident in, and a safe bet. If we enter a recession, this position can go up while stocks could go down. So it's really a very good probability win for us over time, especially after coming off the longest bear market in US Treasury history, about 2 years in length. We didn't change our Coinbase position. There's some pretty nasty testimony in the crypto space relative to the FTX. Sam Friedman's girlfriend is talking about money laundering, bribing government officials, manipulating markets, everything under the sun, and implicating Grayscale Trust, in fact, through Genesis. So probably why we see the NASDAQ jumping while Bitcoin is remaining flat. Probably some FUD there. On NRGU, we doubled down, not knowing that the Middle East was about to enter an epic war. I'm not necessarily expecting politicians to allow this to get out of hand. The people at war rely on the income from oil, and the US is heading into an election. So there's really no reason to make oil prices go up. That'll give Russia a huge advantage against Ukraine, while temporarily Ukraine funding is dead in the waters. Now it looks like Scalise may get awarded the House speakership, and it looks like they're going to try to pass a huge spending bill to provide aid to Ukraine, Israel, and Taiwan in one big package. So we'll see how that plays out. Meanwhile, we did add GBTC and FNGU to the portfolio, and I like this positioning. So we're 4.8% long the VIX, 25% long treasuries. So that's our defensive positioning at about 30% of the portfolio. Remember, we had half our money in the dollar, which is a defensive play, and waited about 4 months to make this trade alert. So we've been very patient, and perhaps we nailed the very bottom in TMF to the T. My own personal investing did not do that. I was much more conservative and just cautious for portfolio builder members, and that did pay off for you so far, assuming that we did call the bottom in TMF. Coinbase, I'm expecting to have a nice big rally. It's basically a leveraged way to play crypto. We got Paul Tudor Jones on TV saying he doesn't like stocks, he likes Bitcoin and gold. Well, Coinbase and GBTC are basically proxies to both of those, one with leverage. I still like the big tech companies. AI is just getting started. They have massive cash balances. They're not being affected by the high interest rates because they have so much cash in their portfolio, in their company balance sheet. They're actually earning a profit against the net interest paid. So with all the money they borrowed at a low rate, they're putting it into money markets and making huge cash flows risk-free. So that's our portfolio. I don't really see us changing much in the near term. If anything, maybe add BOIL. We did have a gas line sabotaged over the weekend, and perhaps this could be used as a wild card in the Ukraine-Russia war, and mainly trying to put pain on Germany and other surrounding countries with high gas prices. So maybe we'll look at adding natural gas. It's been going straight up for the last 3 months. So maybe look for a pullback on that. Maybe too late to find a pullback. We'll consider that next week. Here's our returns, 51.37% year to date. Last year, we were up as much as 50% and gave it up at the end of the year, closed down the year prior. We had a 233% return. We launched in 2020 with a 4.7% return in December. Okay, so tomorrow's big inflation prints. The headline and core are expected to fall by 0.1 basis points. And I think that will likely happen or a beat. I'm not expecting for the inflation to be too hot. So hopefully we'll have a nice bull move to close out the week in our inflation bets. Excuse me, not our inflation, but inflation bets that it's going to fall, which is again basically betting on the tech stocks, the cryptocurrencies, and the treasuries getting a big bid. And this chart is looking at NFIB prices planned. And again, it's basically predicting with this data, at least, we're getting similar data with PPI. So PPI came a little hot today. It's been rising the last 3 months. But again, the CPI is very far trailing this data. And so this is essentially predicting that we're going to bottom out on inflation around 3% and then maybe bounce around from there. And again, the Fed's target is 2%. So we'd like to see some of the leading data continue to hit 0 or negative to help drag this expectation towards 2. But for now, we've got a good year runway, expecting inflation to fall towards 3 for the time being. One of the sticky parts of the inflation has been wages. Now, again, the Friday non-farm payroll came out last week, and it was a huge beat, almost twice as many jobs gained as expected. But the real underlying message is that Americans are struggling. There's a few rich that are still living it up from the big gains they've had in their house valuations and their stock portfolios. But everyone else is leaving full-time jobs that aren't doing the job for creating enough income, and they're getting 2 part-time jobs. So we had a massive amount of part-time jobs added to the payroll and lost a massive amount of full-time jobs. Furthermore, the amount of people working 2 jobs is at a new all-time high. So this is the new gig economy post the lockdowns of 2020. The world has definitely changed, and people are going to make more money running 2 part-time jobs than 1 low-paying full-time job. Meanwhile, this is looking at the core PCE relative to average hourly earnings. And this is predicting that average hourly earnings are going to continue to fall, which again has been one of the sticky parts of the inflation. Here's the meeting probabilities for rate hikes. Essentially, we're done hiking interest rates without some sort of shock. So if we got an oil shock or we got a wage pressure shock, most likely that'd be the only things that could potentially create these probabilities to go to 1 more rate hike. For now, it looks like we are done hiking interest rates and we're getting that critical Fed pause. Typically when this happens, you get about 12 to 18-month runway where stocks go up, interest rates fall, the yield curve steepens, and then you enter that recession and unemployment starts to rise quite rapidly. Here's producer price index. You can see bottomed out at 0 in June, which is highly deflationary, below the 2% target. Now it's bouncing back up to 2.2. Now again, this is falling from 11.2 like a rock straight down month after month for over a year straight. And now it's only bounced up for 3 months. So I'm not super worried about that. I think that's a natural bounce and will likely stabilize here, if not fall. We're just now starting to see the effect of extremely high interest rates. So we got 8% interest rate on the 30-year mortgage, which has absolutely frozen the entire real estate market. If you're going to sell your house and move, you're going to double your mortgage payment essentially to get the same house. So you could get half the same house and have the same mortgage payment. It makes no sense. So I don't see a big crash in real estate. There's not enough supply. But I just see this entire sector of the economy really freezing over until interest rates begin to fall. Same thing with credit cards. We now have a record high average interest rate on credit at 23%. So the interest rates that have been implemented into the economy are slowly playing out now. If the Fed is not smart, they could definitely overdo it and over tighten. If you're a Bitcoin fan, it's probably the only bullish thing that we've seen in the last 24 hours because price action has not been happy. With the NASDAQ going up, we'd expect Bitcoin outperforming NASDAQ 2 to 3 times. Instead, it's been falling. And again, probably relative to this FTX trial, a lot of bad juju being revealed in the testimony. But Jim Cramer says he expects Bitcoin to go down big. And so again, everybody jokes that he's a inverse trade alert to follow. This is looking at the impacts of the global investment institutional capital and what impact that would have. If we were to get the current micro market cap of crypto, it's around 1 trillion. If people were to put 1% of all capital into cryptocurrencies, it could jump us up towards 3 trillion, 2.5%, 5%. All of a sudden, we're looking at a $5 to $10 trillion market cap. So you can see just how big the potential is when these big leaders in the industry get spot Bitcoin ETFs approved. Because again, they have the right to go in, call their clients, buy the ETF for them, and allocate that capital. This is looking at the Bitcoin halving cycle. This is where the cost to create Bitcoin doubles after so many blocks are mined. It tends to happen every 4 years. The first one only took 2 years. Since then, it's been about 4 years. And we're coming up on that next Bitcoin halving cycle. It tends to have a melt up, a little pullback at the event, and then a further melt up for about a year. So a lot of these estimates are putting Bitcoin around 130 to 200,000 in November of 2025, which would also really line up with where we think inflation is going to potentially bottom out in the short term. Now, this is supposed to be the hot month for crypto. You can see it's had a lot of its very high returning months in October. And so far it's been a doozy. We're still very bullish with all the events coming up. But again, we do have this FTX trial. It also looks like Binance is selling customer assets to protect the Binance coin. And we're seeing that because BNB is falling less than other assets. So, and the same thing with Tron. We know these are two companies overseas that were being targeted specifically by FTX, quite likely for politicians. And now we know the SEC and Department of Justice are going after Binance in retaliation of killing FTX. We know that FTX was essentially a money laundering scheme for politicians in the US. Now, if we look at Q4, we can see this is a quarter where we either get triple the return of stocks relative to Q3 or double Q1 or Q2. So we still remain very bullish heading into the end of Q4. And this is seasonality, just looking at it. Typically you get sell-off seasonality-wise and then a nice rip into Christmas. Now, I want to point out that the consumer has over $4 trillion in checkable deposits right now, earning, if they're in money markets, earning 5.5%. The second that the Fed starts to signal they're done hiking rates, everyone's going to start going into more risky assets that can make more money. So if you go into the 30-year Treasury, you can get a similar interest rate, but if the interest rates fall, the bond value could go up significantly. That's really going to be the catalyst that sends markets higher, is the long end of the US Treasury curve starting to fall, which is what we're expecting. Now, this is looking at what happens when a yield curve inversion occurs, how long it takes to hit a recession, and when the unemployment rises. And so right now we have a very strong labor market with falling inflation, and the labor market has falling wages. So this is a Goldilocks situation. I'm expecting around 1 year to 2 years before we get into trouble with the economy and get some sort of stock crash. This is the massive amount of debt issuance. This is going to keep the stock market pumping. As long as the US is getting away with raising massive amounts of money. We just raised $500 billion in 2 weeks. And this is going to get flushed through the US economy and keep the profit margins on stocks up and make the relative value of cryptocurrency very attractive. Again, as soon as these interest rates start to fall, that's going to be the real catalyst. This chart's showing you the amount of money we raised since the debt ceiling, which was on 8/4. And again, the second you can see how the debt raising, the debt levels were falling there. That's the debt rolling off right there in the middle. The second that McCarthy pushed through the debt ceiling extension, which is why he got kicked out, they went and borrowed $2 trillion, just unbelievable. But I do think they're getting towards the limit of how much money they can raise. I do think tax receipts are going to start rising again. One of the reasons we've been having to borrow so much is because tax receipts were falling. The reasons tax receipts were falling is because we ran into a period where we weren't pushing enough money through the economy via the government. And right now we're running debt to GDP about 8%. So without that huge amount of debt issuance, the economy would fall due to stocks losing earnings, massive layoffs, tax receipts fall, the government crumbles. So you can see they really just can't stop this debt addiction without massively reducing the size of the government. As far as what we're worried about with the war would be basically Iran and Saudi Arabia trying to hurt one another and destroy their daily production of oil. The US has no interest in this occurring because, again, to make the price of oil rise, which would help fund Russia. And we're already having plenty of problems fighting Russia off in Ukraine. But that's the big risk with the Middle East war, would be some of this production coming down. Again, Saudi Arabia produces 9 million barrels a day, while Iran is producing 3 million. And again, policymakers look the other way to allow this oil to get out of Iran, which is supposed to be sanctioned. Here's a look at interest rates. They're heavily influenced by the Fed. In the green, you can see the 10-year Treasury. And once the Fed pauses, you get that 10-year falling rapidly. And again, that's what we're looking for with all of our positioning currently. The TLT has brought in something like $80 billion, record amount of capital, but that's nothing. The big money is happening outside of the stock market. This is just a proxy to it. And again, remember, there's $2 trillion issued in the last half year. But you can see retail and small hedge funds are buying the dip. And I think that's the smart move right here. You can see after big sell-offs in the TLT, they're usually accompanied by really strong rebounds. And this is the longest bond crash in US history, greatest depth and longest duration. I think it's coming to an end. Now, there's a lot of bond bears out there who are convinced this is just going to never end. And it's that recency bias. It's just not physically possible for the US to roll over $31.5 trillion in debt at interest rates around 5 to 6%. It's not going to happen. It's not possible. And there's no way that that's going to play out. And again, here's the 800-day bond crash with greater drawdown than the great financial crisis of 2008. Now, the crash in 2008 was much more rapid and painful compared to the bond crash. Here's the oversold metrics on the TLT, one reason why we went long last week, and you can see that was a smart move. The RSI was nearly as oversold as it was about half a year ago when we got the first big crash. And again, we believe this is a good long-term hold for around 2 to 3 years. This has been freaking everybody out. Why is the NASDAQ up with treasuries down? And again, I want to point out 8 of the gigantic companies that represent all of the stock market returns this year have borrowed massive amounts of money at low interest rates. They're taking the cash and putting it in money market funds. So they're making like 3.5% for free on a massive, massive cash pile. Plus, they are cash flow hogs. They make so much money. So these high interest rates are actually helping these behemoth tech companies. And that really is why I see this oddball discrepancy. Okay, Safe Growth Portfolio has been buying value. And the only way to make money in the last 2 years has really been playing momentum. So you're playing super risky stuff that's going up straight up, and anything worth value and low multiples was a bad bet. So this portfolio has had underperformance over the last 2 years trying to play it safe, while the high risk has had these extreme returns. This portfolio, I believe, is about to have a 2 to 3 year massive return with very few changes. We have a small hedge, which we could add to potentially in the coming weeks. UVXY is at 1.7%. Treasuries is our large position at 30%. We've already gone over why we like that. EDC is emerging markets. So you get China, India, all sorts of little countries out there that are trading at extremely low multiples. If interest rates fall and the dollar falls, EEM, which is what EDC is times 3, can outperform the SPY by up to 5 to 10 times in different market cycles. So we do think this will eventually be one heck of a value play. We've got a huge Bitcoin position with GBTC. That's the safest crypto position. It's basically a proxy on the NASDAQ. Okay, so it is underperforming in the short term, but Bitcoin's been quietly the best performer this year, even outperforming the NASDAQ despite the recent underperformance in the last week. And then meanwhile, we remain heavily hedged in NRGU. So I don't see Safe Growth changing much. We could add a little BOIL to both portfolios, and we could top up UVXY a little bit in the safe growth portfolio. Its return is down 10% this year, and it was doing well last year till December when the bond crash hit. And again, I don't see us changing anything for several years in dramatic force, and seeing very, very nice returns with again, value plays. Okay, so here we're looking at the 10-year versus 2-year. This is a chart going back to 1980. When the low end of when the low duration months interest rates fall fast, that's when you get this rising yield curve. So we're expecting to predict a recession. We're going to see all these interest rates falling, but the front end is going to drop towards 0, while the long end is slowly heading towards, say, like 2 to 1%. So the beginning move with the long end falling is going to be very bullish. But soon as the recession and unemployment starts rising, the front end is going to drop to 0. The Fed's going to have to cut to 0 in an emergency, and we're already going to be in a stock crash environment. So that's typically what creates this. So right now we can see it started to rise, but it's not even positive yet. So again, I believe we're a long ways away from any sort of serious recession. So long as the Fed pauses, they change their dot plots to signal rate cuts. And again, there's been many instances where they've been able to cut rates and avoid a recession and a stock crash after hiking interest rates up. So we'll see if they're going to do that. And here's the week over week change, not a lot. Now we'll look at some charts. We've got the 2-year flattening out. We've got TMF potentially bottoming. A lot of people think this is a head fake and is going way lower. I highly, highly, highly doubt that. And if it did go much lower, I'd expect yield curve control to come in and you get a massive, massive stock market rally. We're really at the point where if you do the math, the US is insolvent at interest rates much higher than where we're at. Another basis point higher, and we're really just, there's no way to fund the US government at these interest rates. DXY, I believe, is topped out and will begin to fall with interest rates. Here's your yield curve. We can see the highest interest rate on the 3-month is 5.5, and then the lowest interest rate across the curve is at the 10-year at 4.5. So there's a 100 basis points difference in that. FNGU, we are long once again. If interest rates are going to fall and we're about to shove trillions of dollars into the economy, I expect these companies to break to a new high. And again, these are the big tech companies that have dominated the returns of this year. Coinbase hit something like 96, fell back to 76. And again, as soon as they win these court cases, I believe this is going to be a great play long-term as the main centralized exchange for cryptocurrencies in the US with very little competition. GBTC is up 132% for the year. I expect this to outperform as they try to convert to an ETF. Now, the reason why it's up more than Bitcoin itself is because it was trading at a 50% discount window. That has been closed. So expect this to track somewhat closer to Bitcoin. In the last bull market, this was actually trading higher than Bitcoin. And then in the bear market, it was trading lower than it should have. So it's been a wild asset. There is some risk that Grayscale Trust is going to have to be wound down due to obligations of its parent company to Genesis relative to the FTX trial. But again, at the end of the day, I don't see this as a risk to our shareholders buying GBTC because you have the underlying assets held. EDC started the year off really good with inflation falling, then inflation came roaring back, and since then it's down 25%. We're going to hold this. I think this is going to be one of the better returners over the next 2 to 3 years and outperform the S&P 500. We can see oil, Brent oil having this run up over the last few months, but nowhere near where we had the crisis from the Russian invasion. And I don't see that coming back anytime soon. Here's NRGU, which we want to hold as a hedge against essentially inflation coming back plus war. And again, we're getting a nice little bounce on that. Here's your 30-year going way, way, way out of range. Some people think that this is just going to keep going up indefinitely with a recency bias. I believe we're topping out and getting ready to crash back towards new lows. And again, that's the only way the government's going to keep this this Ponzi debt scheme going. GLD trading flat, silver trading flat, UVXY really just trading sideways week over week, slight drawdown. The banking system we're tracking from KRE. If this were to dip below 38, 35, I'd get worried, but staying in there. S&P 500 has had a bit of a pullback and now a rally. The oversold conditions are neutral. And again, if we get a beat on the inflation, expect this to jump. If it's a little bit hot, maybe flat. And if it's really bad inflation print, I'd expect a big sell-off in both bonds and stocks tomorrow. NASDAQ, again, trying to break to new highs if we get that inflation and interest rates falling. Russell 2000 just going nowhere all year. We'd love to see this get a big bid to show that the overall economy is healthy and growing and not just the big tech giants. Consumer spending is slowing down. Chinese exports and imports remain healthy enough. Retail sales remain decent. Credit did collapse a little bit last week. Bank credit continues to grow despite a bunch of regional banks getting killed. The balance of trade remains pretty static between US and China. Consumer credit, as you can see, did change. It's been falling for the last several months. China's PMI remains in positive territory. Their imports remain healthy. And that is our presentation for today. So I'll go ahead and do Q&A. But yeah, I think we're going to pretty much sit tight and let these positions play out for us. Now, if you're interested in getting a lifetime membership, we have a really good deal. So you don't have any more annual fees if you're on a trial. We've also got a special deal for you. Call Dean now to learn more at 505-322-7515. Thank you guys very much, and we'll see you back next week.